Hello, everyone, and welcome to the Principles for Responsible Investment podcast. My name is Cambria Allen-Ratzlaff, Interim CEO at PRI, and I will be your host for today. So it is absolutely a pleasure to welcome our guests today. We have Mark Anson and Hershel Harper from the UAW Retiree Medical Benefits Trust, which has been a member of PRI since 2010. Welcome, both of you.
Thank you.
Thank you. It's great to be here with you.
Thank you. So we like to start with a little bit more about each of you before we jump in. So I'm going to start with Mark. Mark, tell us about yourself and how you've come to embrace responsible investment.
Well, first, thank you, Cambria, for inviting me onto your podcast. I've spent quite a bit of my professional career working for or being associated with pension funds. First, there was CalPERS, the California Public Employees Retirement System, then the British Telecom Pension Scheme in London, and now, of course, with the UAW Medical Benefits Trust, working alongside Hershel and the investment team as we guide the trust through our asset and liability modeling. It's interesting, when the PRA were first founded back in, I guess it's like 2006, 2007, I happened to be in London at that time. And some of the drafting was parsed out amongst a number of asset management companies, one of them which was an organization called Hermes Pensions Management. And at that time, Hermes Pensions Management was wholly owned by the British Telecom Pension Scheme. So I had a bird's eye view to the very beginning of the PRI, and it was a great time to just be there at the initial start of what were then called the United Nations PRI.
Here at the UAW Trust, responsible investments, very core to what we do, is we take a look at a comprehensive set of factors on how we think about generating risk and return. And so it's very important to things we do every day. Overall background here, CIO for the trust. It's a pleasure to get to continue to work with Mark in his leadership role. And as you've heard, his long background with responsible investing and a lot of lessons that can be learned. Now we can think about applying those in a meaningful way to think about generating higher returns on a risk-adjusted basis for our retirees. And so something that, as you mentioned, that we've been a member of the UNPRI since 2010, so some 15 to 16 years now, and have continued to be hopefully in somewhat of a leadership role with various engagements through various organizations and at various industry groups.
That's great. Well, thank you both for joining. So let's get into some of the leadership roles that UAW Trust has taken, because I think, the trust has really been a pioneer in a lot of different areas, especially in engaging asset owners as well as investment managers, and really focusing on ensuring that fiduciary case is always at the core of what you do. So I know we were talking about a few of the incredible projects that the trust has launched. And I want to start with the human capital management work that the trust has been spearheading since, I think, 2013. Now a large coalition of investors, I think around $11 trillion in assets. And just want to start with, why? Why is this a topic that is so important to the trust?
Cambria, I think that as a former member of the trust that you were very instrumental in actually helping us launch those initiatives from a human capital perspective. And as you know, as we think about those who are stewards of the capital that we allocate and thinking about at the ultimate level, the organizations that are invested with, whether they're public companies or private companies, understanding the overall governance framework and how they discharge those duties are very, very important. And so I think one of the most important assets for any organization would actually be their employees and the people that they hire to execute day to day, whether it's in the manufacturing sense or in a services sense. And so really understanding how they take care of their employees, how do they promote, how do they think about diversity, how do they continue to train and develop, but then also the compensation structure. And I would also think about that at the board level as well. And what is the ultimate compensation for leadership structure? So are they being rewarded for performance? And so being very focused on that. Board diversity, I think, is another key aspect for us to think about, how are corporations continuing to develop effective boards? And not only diversity from a gender and racial perspective, but also from a talent perspective. And so thinking about someone who actually brings into the audit committee, whether it's a CPA background or some form of an accounting background, you probably want legal expertise. And certainly today, with cyber and AI, someone with a tech background would make a lot of sense. And so there are a lot of different skill sets the board should be continuing to focus on and continuing to develop, not only at a skill set basis, but also at a leadership perspective. And so, how are they actually developing these board members to take on leadership roles, whether it's a conflicts committee, audit committee, or even the chair leadership position? So, there's a lot of things that we look at from a human capital management perspective. One of the most effective ways we can get more insight into that is more effective disclosure. And so, that's one of the things that we continue to champion and promote for.
When we look at it from the asset management industry, that the most precious resource in the asset management industry is the human capital that you employ to help you manage either a pension plan or a mutual fund, a hedge fund, whatever. And as a result of that, in the asset management industry, we think about talent acquisition, finding the right talent, getting them in-house. And then it's talent development, ensuring that those people have career paths and they have growth potential within the organization and that they're given great projects to work on. And then, of course, it's talent retention. You want to pay them well. You want to compensate them well. You want to ensure they have great benefits so they stay with you. So when we look from the asset management industry, we do all this for talent development and acquisition and retention. And then we kind of assume, gosh, why isn't every other industry like that? And the fact is, every other industry is not like that. And as a fiduciary of a very large pool of assets, we recognize that there are many other industries where workers might be taken advantage of. They may not be properly compensated. There may not be growth development. There may not be sufficient medical care applied. They may not be looking at diversity initiatives. And so those are critical things that help us put together a talent pool that manages the trust assets. We'd like to see a similar thought process be applied to other organizations, corporations, and industries in terms of talent retention, development, diversity, and making certain that the talent you're bringing in-house has a growth trajectory. From the board's perspective, the board of the trust, one of the things we recognize is that the trust is not an island. Yes, we're a very large institutional investor, but with that, it's important for us to reach out to other institutional investors to share our ideas, our concerns, and see if we can band together where we can leverage the key issues that we have and have a greater impact. Maybe in a moment, Hershel, you might talk about what we call the MIDI, the Midwest Investor Diversity Initiative, is just an example of that. The second is we like to have clarity of purpose. What is it we're trying to accomplish? And this is where Hershel and his team come in, and indeed where you used to come in, Cambria, in terms of what are the critical objectives and critical issues that the trust should be following up on. And then the third part is having an educated and supportive board, and that's where I come in as the chair of the investor committee to ensure that the rest of the board of the trust is completely up to speed and that they're supportive of the initiatives that Hershel and his team are undertaking.
I'll say here in our own backyard in this region, the Midwest, and Cambria, I know you're very instrumental actually launching this and pioneering it yourself, is the Midwest Investors Diversity Initiative. And this is really where we've taken a look at corporations within the Midwest and had a lot of dialogue with them with respect to how do they think about recruiting and retaining a diverse board and making sure that when they do go out for new board members, that there is a slate of diverse candidates. And so that's one of the things we've been instrumental in continuing to grow and seeing an expansion of diversity across multiple boards here in this region and have a lot of support from multiple investors in this region as well. And so it's been a huge success. And we think that we've continued to see an uplift with respect to diversity, but also long-term sustainability of some of these companies. And we think it's really an overall good business practice as they represent more folks that they would actually market to and sell to and continue to drive revenue from. So it's been a super success, and we appreciate all your efforts there and continued efforts that we have here as well.
Thanks, Hershel. The one thing I love about the trust perspective is really, you're trying to pull from the biggest pool possible, trying to get the best talent in the room and making sure there's opportunity, and you're ensuring that boards are doing that when they're thinking about, who's next. So really, a lot of the work that has been done with the search firms and thinking about things like, making sure that slate is diverse helps, I think, bring those voices to the fore and improve the selection process, of course, improving the value for investors like the trust. So it's great work.
And I think as a larger investor base, the access and the ability to have the conversations with the CEOs and the boards themselves, I think they're really open to it and they're receptive to listening to meaningful investors as well.
That's great. That's great. All right, so let's pivot a bit. The idea that right now, in the current environment, we have a bit of an all of the above energy policy, and so the trust has, I think, done a lot of thinking around energy and how that plays into the portfolio, and not just delivery, downstream, upstream, but also thinking about things like data centers. So I want to start with kind of the energy piece first. And Mark, when you're thinking about things like renewables and climate risk, how does that thinking play into your decision making and your process as CIOs, and of course from a fiduciary perspective?
We've all heard the expression drill, baby, drill. Now, we do need natural resources to run our economy, and not just the economy of the US, but the global economy. So that's just a fact we have to accept. The critical issue is, okay, if we're going to drill, and we do need to drill, whether that's drilling for natural gas or oil to meet our energy needs to fuel our economies, are there responsible ways that we can extract those natural resources that are least disruptive to the environment? Our planet is a precious resource, and it contains many great natural resources that we can extract and use to help fuel our economies. But at the same time, we need to protect what we have. And so one of the critical things we look at is just what is the responsible process for drilling in the United States. We think of drilling for natural gas or oil, or when we hear this expression fracking, well, that takes a great amount of water. In fact, the extraction of any natural resource, whether it's natural gas or oil or copper or some of the precious minerals we need for battery construction, all require tremendous amounts of water to extract those natural deposits out of the earth. It's one of the critical things we look at is what's the resource efficiency? How much water are they using? Are they recycling the water? Are they cleansing it afterwards? Those are critical inputs as to how we think about constructing our portfolio. And it's critical when we evaluate the managers with whom we're going to allocate capital. Yes, we understand that we need to extract natural resources and minerals and oil and natural gas to fuel our economies, but can we do that in a responsible way? As I said, that's creating the least disruptive impact to our planet.
From a trust perspective, well, I should take a step back to make sure everyone understands that we're a 100% allocator. So we're hiring managers to invest on behalf of the trust for these different strategies. So we have a lot of engagement also at the manager level to understand how they're thinking about the more comprehensive sets of risk. Some of the engagements, as you talked about, especially within fracking, is our view was not to go out and ask managers of the portfolio companies not to frack, but to understand how they're actually putting in responsible practices around fracking to minimize any damage to water tables, environmental risk, and also have more of a closed loop system. So they're recycling and reusing more of the water. So there was an engagement around that. And a lot of that just goes back to having resilient practice around fracking and ongoing production of oil and gas. So that's more from an engagement perspective. Some of the work that we've continued to do with the oil and gas companies or with our managers around that is obviously it's a very dangerous business. And then how do they think about worker safety and improving worker safety and protecting those assets as well? And so that's some other forms of engagements. And I would say overall, as we think about the energy demand, especially growing demand with the increased use or development of AI data centers, data requirements and the power requirements, for the data centers are only going to grow. It's going to have to grow massively. And so right now, today, I anticipate that the coal and oil-fired plants stagnate and become less of the overall energy picture. But I think natural gas will have to become a growing part of that way to continue to generate power. The question will be out for nuclear on the timing of that and how much we can actually put back online or increase. But then I think that renewables can play, and the storage of that power can play a very big role as well. And so I think we're going to have to pull on all the resources and all the ways that we can increase the power generation for the growth of data centers. And also from the water aspect for data centers, right? The cooling aspect of it, and for other manufacturing processes as well. Well, you're talking about advanced chip manufacturing and the consumption of water. And so how are they going to work within those communities, especially where they're putting these facilities in water stressed areas already? How are they going to work with those communities to balance out what's required for the residents and the municipality in addition to the new data centers in that area? So that's a lot of engagement we're doing to really try to understand that risk, because the last thing you'd want for the data centers obviously would be to have a lot of disruption. That would not be good from that aspect. Nor do you want to have a lot of disruption in your residential water services as well, or the other water needs for the municipalities. So there's a lot to think about as we continue to see the U.S. economy grow and to grow in new ways. And we want to be part of that growth, but we also want to understand the full risk and return picture.
And I would add to that, the epicenter of data centers in the United States is still Northern Virginia. But there are other growth sectors where data centers are being built very quickly, particularly the hyperscale, the huge server farms. And interestingly, one of the new centers for data centers is Phoenix, Arizona. Now, you'd think, okay, why Phoenix? Well, first, land is cheap. It's in the desert.
It's hot.
As you point out, yes, it's hot. So the chillers, the air conditioning units that you need, basically have to run overtime to keep those data centers cool. And of course, it's in the desert. So water is very scarce. So how that water is going to be drawn, how it's going to be recycled, and what it might mean in terms of water rates for the general population, the local population of Phoenix, it'll be fascinating to see how that plays out. And that's some of the themes that we're trying to build into our data center portfolios.
It's great. It's interesting. I don't know if everyone knows. So the UAW Trust is located in Michigan, and there is a huge feeling of ownership around water in particular. So a lot of these topics, especially water, I know we spend a lot of time on, but when you think about some of the topics that you've both brought into this conversation about communities, community impact and the risks that are associated with that, it really broadens the scope of what you have to think about as an investor. Will these projects get off the ground? Will they face community pushback? And then what's the opportunity in the long term when you're holding them for a long period of time? So a lot of topics coming out of that. Let's pivot over to your managers. You talked a little bit about, when you're thinking about how to select managers, but perhaps thinking about how to build sort of a community of or stable of really great managers. And the trust has been very much at the forefront of this with Capital Connect, which I'll turn it over Herschel to give us a little bit more background on what that is.
Well, thank you, Cambria. So Capital Connect, we're actually planning, so a little bit of a plug. August 6th, 2026 will be the next date for our Capital Connect Forum. And this will be our fourth time to do it. We do it every other year, so biannual. And really what we're trying to do is bring together allocators or asset owners, the consultant community, as well as OCIO community, with very interesting, innovative managers from diverse managers and emerging managers, and really getting the conversation going about how you can discover wonderful, great ideas for your portfolio. And I think it's been a space, and it's been well noted, that there's not a lot of capital flowing to some of these managers or to a lot of these managers. And we actually find it as an opportunity set for us to expand our overall investment universe and find great investment opportunities for some up and coming managers, some managers who may be still early in their life cycle in funds two or three from a private markets perspective. Or maybe they're 5 or 6 years into more of a public markets type portfolio and continuing to build their business. And so you can find some really interesting opportunities, have a lot of great conversations, and really expand your mind and learn. I think that's one of the other big things, is actually having the conversations and learning from one another as well, because it's a underappreciated area or underallocated area. And I would say that, think about it from, you're actually going out and looking, as Mark used earlier, as we think about employees and talent, we're looking for talented managers, and they come in all forms, shapes, sizes, etc. And you have to cast a very, very broad net, as opposed to, one of the traps I think allocators fall into, especially if you've been doing this for a while, is you may have your top 10 or 15 managers and your favorites that you know and you've built long relationships with. Well, we really want people to expand their horizons and go out and understand the broader universe, to understand broad opportunity set. Because if you're limiting your opportunity set, you're limiting your ability to generate, higher risk adjusted returns in our view. So looking forward to our next forum.
It's great, great. Yes, and as are we. And I think we're gonna be there during your forum. So very much looking forward to it. Mark, anything to add on the work, because you've been doing work like this for quite a while. I think starting with CalPERS.
That's right. So it's fascinating. CalPERS started their diverse manager program 21 years ago, 2004. when we think 20 years, it's hard to think, gosh, 20 years ago, what were we doing? Where were we? But back then, there wasn't a lot of discussion about diversity. There weren't forums like the Capital Connect, and we were just trying to put it together as we went along. There wasn't a lot of information. There wasn't a lot of data. There wasn't a lot of support for the program. But we managed to get it off the ground, and then we had a lot of lessons that we learned from it. We first started that program by looking for emerging managers in the public equity space. That was where we first had a need to define good managers, and then it took us time to expand that into other asset classes. And that was, I think, one of the lessons learned at the outset is when you're going to start one of these programs, you don't have to limit it to a specific asset class. We did that at CalPERS just to get the program off the ground and then expanded it from there. But anyone who's starting a program nowadays, you should not limit the program. You shouldn't limit the amount of assets you're willing to commit, and you shouldn't limit it to particular asset classes. As Hershel said, we want to cast as broad a net as possible because we are in the business of finding great talent. That's what generates great returns. And the more you constrain your ability to do that, the less of an opportunity you have to generate the great returns you need for whether it's a pension fund or an endowment or a foundation or a mutual fund. So that was just one of the lessons learned. And again, 21 years ago, hard to believe it was that long ago. But at the time, we were trying to figure it out as we went along.
One of the things I would add to that too is that I think there's been enough research out there, and it's out in the public to dispel any myth that if you're investing with a manager who may be classified as diverse, that and somehow that's some concessionary return. That's just not the fact. And so there's enough studies out there that dispel that from the industry or that perception at least. And so I know from our own experience in looking at our managers who would be classified as diverse, we don't see that there is any form of a concessionary return environment. We do a very thorough due diligence process, not only in the investment component of it, but also the operations. That's very important to us on how do you operate your business and do you have a sustainable business from compliance, legal, regulatory oversight, cash controls. So a lot that goes into it. And so going through that investment process, the operational due diligence process, there's a lot of learning. And sometimes we've hit a point with managers who we actually share, this is why we're not investing with you today until you put these operational controls in place. And we've seen managers take that very seriously and actually spend 9, 12 months of actually making those changes and having an ongoing dialogue with us. And we've gotten to the point that we really did like the manager and their investment strategy. And then we got to the point that from an operational perspective, they could continue to execute from that perspective on a go-forward basis. And then we eventually made an allocation. So there's a lot that goes into it, but I do think that ongoing dialogue and telling managers why you're not investing now is a good part of the story. But I do want to go back to my original point that if you're investing in a manager that may be classified as diverse or emerging, that does not mean concessionary returns.
I would just build on that. In my day job at Common Fund, we also have a diverse manager program, very similar to the trust. But to build on Hershel's point, once we hire a manager, an emerging manager, a diverse manager, they're subject to the same level of scrutiny and examination and performance demands with any other manager, and they have to live up to that. And if they don't, then they will exit our portfolio just as any other manager would. So they have to stand on their own 2 feet.
Yep. Yeah, absolutely. It can't take concessionary returns even if you wanted to, basically, right? Nope, and you don't want to. So let's pivot a little bit because I think what we've been talking a lot about is the trust's history in thought leadership. And now you both have produced thought leadership recently, a pair of papers, one on the fiduciary aspects of responsible investment or sustainable investment strategies, and then another one about how investors deal with, or how you as investors deal with inconsistent data and how that plays into your decision making. So perhaps I will start with Mark. Tell us a little bit more about this work, and also curious why.
Sure. Yeah. The 2 papers we published, Herschel and I put together in the last year, one was looked at from the perspective of the fiduciary. So if you were sitting as a fiduciary on the board of the trust or an endowment or a foundation, we drafted that first paper to take it sort of from a top-down view of how should a fiduciary think about this. And in fact, that was the title of the paper, The Fiduciary Dilemma, the Appropriateness of Integrating ESG. The second paper then took the bottom-up approach. Okay, now as a CIO, so from Hershel's perspective or my perspective at the Common Fund, how should you think about actually taking ESG and building an investment program around it? And there's two issues that we quickly identified. One is, as you alluded to, Cambria, the research out there is decidedly mixed. There are literally thousands of papers out there on whether ESG, the environmental, social, and governance metrics, can add or subtract value from a portfolio. And in fact, there have been a number of studies that summarize all this literature. And the best known one was a paper by three authors called Trade, Bush, and Bassett, and came out in 2015. Just a quick summary, they looked at over 2,000 papers that examine whether ESG adds or subtracts value to an investment portfolio. What they found from those 2,000 papers is that 48% of the papers reported a positive relationship between ESG factors and performance. About another 40% found really no impact, and about 11% found a negative impact. So the first point is no matter which position you're taking, ESG adds value or ESG subtracts value, there are literally hundreds of papers out there that will support that position. In other words, the research is decidedly mixed. And so the second thing we did is we asked ourselves, okay, well, why is that? And the fact is that there are a number of ESG rating agencies out there. MSCI, ISS, Sustainalytics, FTSE Russell, Northern Trust, etc. And they all have different metrics they look at. Not only do they look at different metrics, they rank those metrics differently. So that can lead to a lot of confusion and actually contradiction in terms of how some either companies or investment managers get rated. In fact, one of the things we found in our research is one ESG rating agency rated one group of companies as having very high ESG metrics, while another ESG rating agency rated those same companies as having very low ESG metrics. So what it basically means is it kicks it back to CIOs like Hershel in managing the trust to sit down and first figure out what are the objectives of the trust with regard to ESG? What are we trying to accomplish? As we just said, we're not looking for concessionary returns, but how do we build a program that can actually extract alpha and build it into our portfolios? And then what's the best rating agency that gives us the opportunity to do that? So that was the big overview. I can kick it back to Hershel for a few more details.
So yeah, I think it's Mark really hit on the disparity of data depending on the types of or which vendors you're going to and how they think about the definitions. And so I think it's really important for all fiduciaries, regardless of your plan type, whether you're at a family office, church organization, foundation endowment, or a pension like ourselves. Obviously, we focus on healthcare benefits. To think about your regulatory environment as well is really key. Because let's think about from a public pension fund perspective. They're created by state statute, 50 states and multiple pension funds within each of those states. And so that's really what they need to pay attention to. And that may be supportive of ESG factors or could be non-supportive of it. And so I think people need to really understand the regulatory environment. And as Mark said, I think our main focus is really about how do we produce the best risk-adjusted returns to pay for the healthcare benefit for our retirees. And we're not going to take concessionary returns. That's just out of the question. But we do view, and I actually like the categorization of the risk around ESG. I think that's a great way to categorize and think about the risk overall. But we do really think of it as more of a comprehensive view of risk and return and where you can identify some interesting opportunities as well. And so we do try to think about it from a more of a holistic integration to how we think about our investment process. Then also in that conversation with managers on how they think about it within their investment processes as well. And we would tend to prefer managers who actually think about risk and have more of an engagement and discussion with those portfolio companies around the risk and how they mitigate or manage or take advantage of those to actually create some additional return opportunities. And for us, we think that's a better approach as opposed to using a simple rating. I think the ratings themselves and the research that go around them can be very instructive to help you think about those opportunities as well. So I don't want to completely dismiss those at all, but our approach would be to preferring much more of an engagement in a dialogue with those portfolio companies on how they think about it, incorporate it, and manage those overall risk.
Right. Just to build on that, in the one of the papers we drafted and published, the one with from the CIO's perspective, we list the number of rating agencies out there, and we show the different ways they rate ESG. The key point being is, okay, there's a lot of difference, as Herschel indicated, disparity between how they rank companies and indeed investment managers. The critical part is, back to Herschel's point, what is the regulatory regime under which you operate as a pension fund or endowment or foundation? Then look for that rating agency that best is aligned with the goals you're trying to accomplish. Are you trying to generate excess return? Or are you trying to use it as a risk reduction method? And the different ESG rating companies have different focuses. Some are trying to generate better returns. Some are using ESG and using their ESG rankings as a way to reduce risk in your portfolio. So again, figure out your regulatory regime. What are you trying to accomplish? And then pick the rating agency, the ESG rating agency that best aligns with your investment program.
Yeah, no, I would add to that. I think probably very common practice, especially within, let's say, a family office or high net worth individual perspective, they're going to have a lot more degrees of freedom because it's their capital and they can make their own decisions with less of the regulatory oversight, say, that we would have from an ERISA perspective, or that maybe a state pension fund would have from their state regulatory bodies. But I think you typically hear a lot thinking about values aligned investments and what's consistent with their core values as investors and as people as well. And so I think that's a very common practice of it. And then, as Mark said, having an understanding who the different vendors are for the different types of ratings and who aligns best with what they're looking for. So I think there are multiple firms out there who actually do the different ESG ratings or scorings. I think that, there's probably a benefit to having multiple perspectives in the market. Each investor can figure out who aligns best with them as well.
It sounds like a common theme that's coming out is really, investment practice, maybe broader, has to do, it's contextual, right? So the UAW trust, you have retirees, you have a certain life of the fund, and your job is to pay benefits, versus a pension fund versus a sovereign wealth fund, and all of these pieces, including the regulatory environment that you operate in, lead to different decisions. Even sometimes looking at the same data, but may also impact the data sources that you choose. And this is back to the point about the opportunity set and how important it is to keep that as wide open as possible because there are different decisions that you're making all the time. Is that fair?
Yeah, it is. In fact, it's a great point to think about. When you look at an investor, whether it's a pension fund like the trust or an endowment foundation, or even us as individuals, each of us or each entity has a liability stream that has to be funded. In the case of the medical benefits trust, it's very clear. We have to be able to fund the health benefits for a very long period of time for all the UAW workers. If you're an endowment for a university, your job is to fund, of course, the growth of the school. The endowment is used to help pay the operating expenses of the university, give out scholarships to the students, help build new facilities, and extend into the next generation of students. So there's a clear liability stream. If you're a philanthropic foundation, you typically have a very clear and specific donation schedule and view of philanthropy that you're trying to implement. And then we as individuals, we have two liability streams, our retirement and our kids' college education,
Yep.
which I'm still trying to dig out of. But you start with that. What is the liability stream that you have to fund? From that, you build your long-term strategic asset allocation. Then, as Herschel indicated, you have to overlay on that the regulatory regime under which you're operating. And then you start to think about, all right, how do we build ESG and responsible investing into our portfolios? What are the degrees of freedom, as Herschel said, that we have to do that? And what is our goal? Again, is it meant for risk reduction, return enhancement, or are we just taking into account the societal externalities that we see occur all too frequently, and we're trying to correct that? So again, gets back to the basics. What's your liability stream? How does that build into your long-term asset allocation? What's the regulatory regime under which you're operating? And then how are you trying to accomplish your goals?
I love that. Back to the basics.
Yes.
So let's maybe go into looking forward. So what are the opportunities that you're seeing? I mean, now I have two CIOs here, so I can't. I have to take the opportunity here. What are you seeing in your as your outlook for the UAW Trust, or even Mark, your CIO, also the Common Fund. Open it up to who wants to start.
Well, I'll start a bit on the trust, and we have a moment I can also comment on the Common Fund. Through Herschel's leadership and the great work of the investment team, the overall investment team, and you were part of that, Cambria, the trust is in the very fortunate position of being able to de-risk. So what does that mean? It means we're allocating more and more into bonds and traditional fixed income assets because the pension fund right now has a funding ratio far in excess of what we think is a comfort zone for solvency, which means we're very well funded right now. Again, the returns that Hershel and the team have been able to generate over the last decade, and again, Conver, you were part of that, have put us in a great financial position of strength that we can now take some risk off the table. So just one of the things as we look forward with regard to the trust is we no longer have to worry about investing as much into risk-based assets to generate high returns to pay those long-term liabilities.
One of the things we look at, and one of the things we actually do because we're a closed plan, and so we received early on all the funding we're ever going to get, and so you really have two legs of that stool as opposed to traditional three in a public or a pension fund sense. Normally, you would have contributions coming in from employee and employer, the investment earnings, and then what are the distributions for benefit payments. We've received all the funding we're getting up front, and so we really rely on making those assets last and what are the earnings we get on our assets and understanding that liability curve for what are those contribute or pension payments going to be out for healthcare benefits. And so one of the ways we mitigate that risk is we actually do an annual asset liability study. And the reason we picked annual is because healthcare benefits can be so different than traditional pension benefits for retirement. And so healthcare inflation is very different. We're actually having a conversation yesterday in our committee meetings that you think about the number of professionals coming or people coming into the medical profession, it's shrinking, it's not increasing. And so that in itself creates a risk. If you have less supply of doctors and nurses and healthcare professionals, and we know we're going to utilize healthcare more and more into the future, you get that imbalance. And so that tends to speak to something that could be a little bit more inflationary. So really thinking about what that inflationary impact could be on our liabilities is one of the core things that we really do think about. Now, as Mark said, back in 2018, we actually hit that point where we started that conversation and we took a small step towards de-risking. So selling down some of the equity and putting more into bonds. And so then in 19, we continued to take the bigger step towards de-risking. We've done so gradually over the past 5 years. But the one thing the board has always been focused on, and we've been focused on with those discussions, is you can't de-risk too much. Otherwise, you've created more risk for yourself. And so how do we really balance that out? And so I think, actually a lot of compliments back to our board to have that discussion and think through what that is and take a reasonable step towards de-risking over time as opposed to trying to do it all in one fell swoop in 1 year. With that said, one of the things we started a couple of years ago is we actually reorganized our assets into two super asset classes, one of which would be income. And so within the income category, think about things like traditional bonds, like Mark said, investment grade bonds, but also refer to it as credit driven. So think about that as below investment grade, but that could be everything from direct lending to alternative credit. It could be lending against hard assets as well. So think about, real estate, transportation assets, and what have you. Within the growth category, that's exactly what you probably guessed, right? We're really thinking about capital appreciation. And so that could be public equity, private equity, equity investments in real estate, infrastructure, and energy. And so we're approximately a 70% income oriented portfolio and 30% in growth. But we do think about within each of those categories, what are the best opportunities, taking a look at current market environment, but then also thinking about the future and direction of where we want to go. Because it does take time to turn a $60 billion portfolio. Liquidity is precious to us, right? We're paying out benefits every year, but we also know we don't need 60 billion today. And so we do have the ability to take some illiquidity risk through the private markets as well. And so we are looking at opportunities, whether it's in a lending format or equity-based format as well. So investing in private equity, investing in private credit as well. And so we do think that we can generate some outsized returns and actually capture some additional premium by giving up liquidity. We have to remind ourselves that a 6% return is really good for the portfolio allocation we have. And if you take a look at public equity markets, the past 3 years of double-digit returns for every year, they've been doing very well. But if you break that down, you can attribute most of that to 7 stocks.
That's right. The Magnificent Seven. Yeah. Mark, what about you? Tell me more. What common fund?
So at Common Fund, our clients are primarily endowments, university endowments, and private foundations. So when you think of endowments, they are perpetual. They will operate generation after generation. For example, our son is at Northwestern now. I met my wife Mary at Northwestern. My mom and dad met at Northwestern. So he's third generation, and maybe there'll be a fourth generation of Ansons at Northwestern. But the point of that funny story is because Northwestern is considered a perpetual organization, generation after generation, they don't, underscore, don't have the ability to de-risk. They have to continually take risk to generate long-term returns, what we call intergenerational equity, to fund the next generation of students and buildings and professors and research grants that Northwestern will need. And it's not just Northwestern, it's every university out there. So de-risking is not an option. And in fact, what we find from our client base right now, the endowment client base, is still a very high commitment to growth assets, and in particular, illiquid growth assets. So private equity, venture capital, real estate, data centers, still very popular investment theme. For foundations, they too tend to have a very long-term, if not infinite life cycle. The difference, though, there is the foundations tend not to fundraise. They tend to be a one-time funding from a wealthy family, a wealthy individual. But the key point is for a foundation, just like the trust, the funding typically is one and done. And so there, without the safety valve of being able to do additional fundraising, you might be a bit more cautious in your risk profile as well as your liquidity profile. So it's a different way of managing endowments versus foundations. Both still have very high and long-term commitments to growth assets, both public and private equity.
It's great. And I think that underscores the point that really investing and investments are very much dependent on the circumstances, on what you're trying to achieve, on who you're investing on behalf of, and your time horizon and a bunch of other things. But it's not sort of a plug and play, paint by numbers in any way, shape, or form. Well, thank you both for joining us today. I want to just take an opportunity if you have any parting words for our listeners.
I guess a couple parting thoughts is that I would remind boards to think about, responsible investing, how they think about it, how they define it, what their beliefs are. You get really comfortable around that and what that actually means to you, because I do think it's a very valuable tool or a way of looking at investing so you can actually capture a more broader sense of risk, return, and opportunity. And I know that there's a lot of chat out there today about what should be and what shouldn't be, but I really do think the core principles, you're really trying to find good, sustainable, resilient businesses that can deliver investment returns for you over a long time period. And so I think that's really core to it. And so that's what I would leave people with, is to think about what's really important to you and how do you execute on driving risk and return overall.
Thanks, Herschel. Mark?
I would add two thoughts to that. One is, we all live on the same planet. So in terms of how we manage this planet, not only in terms of how we manage our portfolio, we can't separate those two and then just simply ignore the overlap that occurs. And that's what responsible investing is meant to do, is understand how do we extract good return for our portfolio while at the same time preserving and protecting the beauty of our natural planet. That's one. And second, we're all members of society. So, when we think about being responsible members of society, as responsible investors, we have to be mindful of that as well.
Great. And those are great words to end on. So thank you again, Mark, Herschel, and thank you for taking the time and sharing your wisdom with us. And I want to thank everyone for listening. This was the Responsibility of Investment, PRI's podcast, Cambria Allen-Ratzlaff. And if you like this, please subscribe, and we'll have more content for you coming up. So thanks, everyone. For now, goodbye.